Well, hello everyone. I'm Kai, a reporter at Sifted, and you've joined us today to talk about the pretty difficult task of being a CFO during a tech downturn. And the tech world has changed considerably over the past 2 years because of it. This growth at all costs business model has been replaced by a much bigger focus on financial sustainability and path to profitability, as funding options that seemed oh so plentiful during the post-COVID boom times have become a little bit harder to come by. So over the next hour, we'll be discussing how the role of the CFO has changed, how startups can increase that runway, and what CFOs are prioritizing going into 2024. To do that, I'm joined by three, funnily enough, CFOs. And they are Sarah Borchvik from sound tracking platform Epidemic Sound, Liz Kistruck from used car marketplace Motorway, and John Bernard Mowens from travel booking scale-up Omio. Now, there won't be a Q&A section at the end because we want you to get involved throughout. So anytime a question pops into your head, just submit it via the chat box in the bottom right-hand corner of your screen. The questions can be upvoted by everyone else, and I'll put the most popular ones to the panel. But I want to start by talking about how the role of a CFO has changed over the past couple of years. And there must have been huge shifts that have happened as revenue models have shifted, business models have shifted. Sarah, you joined Epidemic Sound during the boom times when everything was looking amazing.
Yep.
How's your role changed in that time?
So I joined Epidemic Sound 2.5 years ago. And I would say, just looking at the CFO role over a longer period of time, I think the role today is much more strategic. It's super important that you have a close collaboration with the CFO and the CEO, and that you also have a relationship where you can challenge each other, but also complement each other. So looking at these 2.5 years, one of the most important responsibilities, I think, as a CFO, that is to see around corners. And I mean, that's hard, but you understand what I mean. To be very proactive, do a lot of scenario planning. I also like to work with the trigger KPIs. For instance, if this happened to top line, then we already have thought about actions, maybe not in detail, but we know what to do on a high level. And back to joining when money was free, it was growth at all cost, and back to the see around corners. So already during my first 6 months, we saw interest rates starting to increase. So actually, as soon you could say as we got the budget approved for 2022, we completely changed the hiring plan and hiring pace. So that is to me an example to see around corners, to be proactive, take those tougher decisions in time, because that would just help you so much later on.
Yeah, makes sense. And Jean Bernard, you also joined Omio in 2021.
Yeah.
What was
It was a bit of a different story to Sarah, but I'm very happy for her. But I joined a travel company in the middle of COVID, which is probably the crazy thing to do. I do believe, and I came before that from gaming. I was with King Little Big Girl of Candy Crush. It was a blast for 7 years, and I thought, coming outside of COVID, travel is going to rebound, and so now is the time to jump on the bandwagon, and I joined Omio for that reason and many others. Unfortunately, what I didn't see coming is that there was yet another lockdown, and so Omicron hit us in 2022 or end of 21. And so we went through those very difficult cycles that the company had already been before, which is that suddenly you have sold tickets to millions of people, and those millions of people come knocking at the door and they say, "Hey, I want my money back," and you have a huge cash problem, because obviously, you pay the transport service for the train and bus companies, and you keep just your margin. But with your margin, you have maybe 1/10 of a ticket value. So you're confronted with those huge swings. But somehow it was really a learning experience for us, and great to see how the company managed to shrink back into a survival mode every time there was a lockdown. So we went through these cycles, and for me that was a big change from my previous job. It is a change also now for us. It's a little bit for the better now that we are outside of COVID. But it is, and I think we'll come back on that theme later, because there's clearly learnings there of, as Sarah was saying, always anticipating, always taking the decisions very, very fast. Don't wait, because if you, as the CFO, you don't impulse the hard decision, nobody in the business will really take those decisions. And that's how we survive, basically, by anticipating those downturns, taking all the measures that was necessary right in time, and flowing through, basically.
Yeah, for sure.
Yeah, and I can also add that I mean, taking decisions in time, but act fast, also cut deep, and then build back. I think it's so easy to think that maybe you don't need to cut that deep, but I would always recommend that, because, well, it's easier to build back.
I completely agree. And because one of the things I think that's challenging as a CFO, I think we're always ahead. Like we anticipate the downturns coming, and we're going to have to make a decision. We have to get everybody to take the difficult decisions. And sometimes when that's happened, everybody just sort of retreats and hunkers down, and it sort of feels like it's no to everything. But actually, as soon as you've done those cuts, you've got to get on the front foot again. How are we going to grow ourselves out of this? So you need people to start saying yes again, and often they're very anxious to do that, and your role shifts very quickly from being the big bad no to suddenly, how do we give people the confidence to take the right decisions and know that it's good? And that's all the things that Sarah said about knowing what your KPIs and how your P&L works, and not waiting. And so one of the reasons to cut deep is it then just gives you that little bit of flexibility to be able with confidence to say, yes, actually do try that thing. That's not going to ruin everything. You get going, because you've got to get on that positive flywheel again as quickly as possible.
Yeah, makes sense. And Liz, you joined Motorway over the summer. What were your first priorities coming into that role as a CFO?
Well, always how much cash have we got, and how quickly are we going through it? Absolutely number one. And what do I think the runway looks like? And particularly Motorway, which is relatively young and has been growing so fast. How do you actually get a control on what you think the future is going to look like? And we don't have crystal balls, but building that forecasting capability, which is, sometimes it doesn't feel like a big value add to spend time, building out your FP&A function. But as soon as you've got to have that critical view, whether it's through some product or through some spreadsheet or just through one genius person, where you can fairly quickly say, this thing has happened. What does that mean for the forward look? Or last week's trading didn't look great. Well, what was it that's in there? And is that a temporary thing, or is that a systemic change that I now need to think about? So I'd say that's the critical thing, because then once you've got control of that, then you can immediately start adding value to your peers around the executive table and the rest of the organization, to be giving them that confidence to make decisions, or being able to confidently yourself. I mean, I've only been here 4 months, but to be able to actually stamp, and it doesn't happen at Motorway very often, but be able to say with confidence, actually, no, I don't think that makes sense, or I don't think that's the thing that we need to prioritize right now, to help, make decisions quickly.
Yeah, for sure. And one CFO recently mentioned to me that they now spend 80% of their time reforecasting. And they were saying it's not just you can't just forecast at the start of the year and then, hey, that's fine. You've just got to be constantly replanning, because things are shifting so often, right? Jean-Bernard, have you noticed that the amount of
Oh yeah. No, it's incredible. I mean, we this year I think we'll have done something like 8 or 9 reforecasts, and the team is complaining that they're like in constant reforecasting mode. But for exactly the reasons that you mentioned, is we see so much things changing so fast that it's mandatory. You cannot ignore them. The analogy that I usually use is that at least you should do 4, right? For any kind of public company or well-run company, you do a reforecast every quarter. So that's normal, and when it changes a bit faster, yes, you double the rhythm. But this year was particularly complicated because of I don't know if you remember, but at the beginning we had like banks suddenly going bust, and therefore we had to reforecast what is the cash that we have and in what bank and what currencies, and move that around and change the rules. And yeah, so it's been all over the place. And hopefully next year will be a bit more of a normal year where we can just grow and do 4 forecasts. But yeah, it's been crazy this year.
Don't jinx next year. Well, I would recommend to implement rolling monthly forecasts. So we've been doing that for some time, and I think it works well, because you're also training that forecasting muscle. But then that is not, of course, a bottom-up, all managers involved. So that's more of an FP&A, some business owners doing that top level. So building a model that is KPI driven, your most important KPIs or cost drivers of the company, and then you do that on a monthly basis. That will also improve your forecasting accuracy.
And have you begun to introduce just rolling forecasts as standard because of the?
Yeah. Yeah. So we did that when I joined, because I like that. So that has nothing to do with the world around us, because I just think it's good practice to do that.
Yeah.
Also, I would say it improves accountability throughout the management team and other stakeholders with P&L responsibility.
Liz, what do you think? Rolling forecasts or less?
I love rolling forecasting, and was a big champion of it in Expedia for a long time, from a long time ago. I think you have because the world is so dynamic, even in a normal year, like things are changing, and you have to know, do we need to react? Or particularly for a leadership group, one of the most important things we can give to our organizations is actually sort of buffer them from some of that. So we give them sort of a safe space and certainty so they can keep acting. So you don't want the whole team to be constantly questioning everything. So, by the finance team constantly doing that rolling forecasting, we can control the moments when we're like, oh, no, this is a fire drill, like something really has happened, a bank's gone bust, we've got to do that. Versus actually, we think this is temporary, or yes, this is happening, but it's not really a big problem yet, so we'll keep an eye on it. Or sort of leaning into, well, something is really working over here, like who's doing that? Like, how do we do more of that? I think if you don't have that strong view coming from the FP&A function all the time, either it's not happening at all and you're going to jump off a cliff, or the other extreme is everybody's trying to do it all of the time, and then they're not, spending time doing their jobs and just running around, and there's a whole lot of noise.
What triggers like an impromptu forecast, Jean-Bernard? Like you mentioned, like you guys have rolling forecasts every quarter. At what point do you go, we need to do another forecast this month?
Yeah, it's anytime you have a material event happening, or the hint that a material event could happen, and I would say it's for the worse, but also for the better. We've partnered up, for instance, with Uber, and we've launched Uber in the UK, selling rail tickets and trains, and we're completely powering them here in the UK. The moment of the launch, the trajectory of the launch, these are things like we're scrutinizing that very closely, because it can materially affect the top line, and in this case it's very positive. If you see that going back to last year, a lockdown is coming up, that's the same thing. You cannot ignore it and just go through. So anything that is material, where you say this is going to impact us, is very important, and that has also an impact on the way we operate. So it might not be material from a finance point of view. Back to the example of cash. There were a contract renegotiation we had to do, changing the currencies, etc., in order to avoid being stuck in some countries. So yeah, anything that can impede materially the operation of the company, for me, it requires a reforecast, or at least very close scrutiny.
Yeah. And like how are you doing forecasting these days? Like Sarah, do you hire analysts? Do you use certain software? Are you implementing more AI solutions into this?
So, I mean, we're a very data-driven company, so we have good data to start with. The forecasting is owned by FP&A, so within the CFO office. I like the forecasting to take as little time as possible from the organization, because it's not really creating a ton of value. But at the same time, you want to achieve the accountability. So that's the trade-off. So I think about the different forecasts very differently. So looking at we do a 5-year financial plan, which we call the long-range plan. That is very much a direction. It's essentially taking the strategy and converting it to numbers. So that's mainly involving FP&A and the management team. So that's not a bottom-up analysis. When we look at the AOP, so the annual operating plan, which is our budget, that is essentially a bottom-up exercise when it comes to the FTE planning. And then it's more high-level involvement when it comes to with the different revenue stream owners, you could say. And then still FP&A holding it together. When we do the monthly rolling forecast, as I said earlier, that is only FP&A with some discussions with revenue owners, P&L owners. And then we do a formal mid-year operating plan that is light touch, essentially saying we will not change anything unless it's material. But back to the point earlier, so when I talk about scenarios, so when we do the budget, the AOP, we will get the base case approved. But then there will be very clear scenarios, both upsides and downsides. It could be a renegotiation of a contract. I mean, it could be, and for us as an entity with a headquarters in Sweden, so our reporting currency is the Swedish krona. It's been kind of volatile lately. So for us, FX is an upside and a downside scenario. So that's the way I think about handling material events, you could say. So you have the base case, but then you have clear scenarios.
Yeah. Liz, what's in your CFO toolkit? Are you using software these days that you didn't before? Are you using like tech like AI?
We're still very early. One of the motorway also very data led, and we have data all over the place. But all of our data trends go like this. So for instance, trying to pick out seasonality when you're growing like 100, 300% year on year, very hard to do. So we're not really mature enough yet to be able to benefit from a lot of those tools, but we're just sort of on that cusp. So we're now starting to, how do we bring them in? But I can't agree more with Sarah about the scenarios. So I also don't like to have the whole of the management team, the whole of the organization, like burning hours, generating numbers, then sitting arguing and discussing why my number says this, your number says that. Because in the end, nobody's going to be right. The forecast is always wrong. You just need to be directionally right so you can make the right decisions. So what those scenarios do, I use those to help sort of predetermine some of those decisions. Look, these material upsides may come through. And when they do, this is the first thing on the list that we're going to do, because you don't want to get to, say, March and you've done like a quarterly reforecast and then you spend 2 months talking about, okay, well, what's the next headcount win block? That needs to be kind of instantaneous. And likewise on the downside scenarios, like, look, we hope we're going to hit revenue here. However, it's not impossible that we could come out here. And if that was the case, we're not going to be able to afford all of these things that we've already unlocked. So, this is going to be the go-to actions, and you can pre-work some of those when everybody is calm and being thoughtful and thinking strategically, so that then you can act much more quickly if any of those circumstances should come around.
What are the metrics that you're prioritizing at the moment, Liz?
Well, growth, but profitability. We're definitely in that. How do we continue to grow at pace, but also cut the burn? So making sure that we really understand, the value that we get from any incremental cost. We've grown the business very fast in the last few years. In particular, we've grown the cost base quite fast on purpose. And definitely into the process of training the organization, we have a lot of people doing a lot of things. How do we make sure that they're doing the most impactful things and not just things that they always used to do? And it's not ideal, but you can trigger a lot of that from the CFO by just being very tight on the cost. You say, you only have this much cost. What are you going to do with it? Because everybody comes with, here's the next thing I want to do. And there's a really brilliant business case for why we should do that. And it always comes with an incremental cost ask. And actually the approach is like, okay, if that's the thing we should do, that then goes into the top of the stack. What is the thing that drops out, the least important thing you've got left? Now give me the business case on whether we should hire to support continuing doing that activity, not the new shiny thing. And when you get into those conversations, then you can start, really thinking about how do you recycle the cost base, and drive out the ROI and productivity of the organization.
Yeah. Jean-Bernard, is AI changing the way you do things? Is it making your life easier, or are we just not there yet, really?
Yeah, we're not there yet. I mean, it has an impact on the company, obviously, but from a business point of view, we cannot ignore AI. If you want to plan your holidays, I mean, at some point in time, this is going to be something where AI can help you, and therefore we have a role to play in there. But that's really on the business side. On the finance side, and just coming back on your previous question, I'm a big fan of Excel or Google Sheet, and we do our forecast in Google Sheet, to be very clear, because I prefer what Liz and Sarah said as well. I think I prefer that we have a simple approach on forecast, that we understand what the forecast is. I've been in a company where we spend most of the time trying to understand what the forecast was before reconciling to the forecast. So I prefer a straight line that I understand, and then we try to see more what's actually happened versus that straight line. And so for that, Excel is perfect. But also it is very easy to point to accountability and derive the KPIs that the organization needs or the managers needs in order to drive the organization. They can read it themselves in Excel, and they can also play on scenarios and say, hey, if I invest into user retention, how does the top line grow, and these kind of things, and should I do A or B? They can do that because they know how to use the tool. So very simple at the end of the day. That's where we prefer, I would say.
Yeah. Now when I'm speaking to founders right now and executives at startups, one of the biggest topics of conversations is we're looking to increase our runway. We're trying to figure out how to increase our runway because the fundraising landscape has just shifted. What are the key things that like a CFO, when they're talking to leadership, needs to think about when they're looking to increase that runway? Sarah, like what needs to be the focus for a CFO?
Well, back to the scenario planning and the tough decisions, but I also think that you should ask yourself, do we have product market fit? Do we have a business model that works? It could also be that parts of your business is working well, parts doesn't. So can you divest? Can you just stop doing that? Because back to your point, Liz, it's not only the new shiny thing. We need to focus and getting maybe more resources behind what's working and not spreading yourself too thin. So that is one area, I think. And of course, is the cost structure sustainable? I would just like cut deep, build back. That is something that you should really do. And just an example from Epidemic Sound is that we created an organizational structure that was prepared for us growing our FTE base quickly. So that led to a restructure now in May this year, where we could simplify the organization. We could decrease the number of support functions. We could also take out middle management. So it could also be the structure of the organization is maybe not fit for purpose when you are going into a tougher macro environment. But also, like, what other changes can you do that will give you results quickly? Like price increases is one example.
Liz, what have you looked at Motorway to stretch that runway?
Luckily at Motorway, we don't have a runway problem. We're actually pretty comfortable for several
Can I
years.
just add that we don't have a runway problem either?
I haven't so it's not been so much at Motorway. Motorway, it's more been like, how do we continue to grow sustainably and not create a runway problem? But when I was at previous company List, we were very careful managing it. And of course, there's headcount and all of the things that Sarah said. And I think in particular, looking at org structure, if you've got an organization that has been designed for absorbing people, that's a much heavier role on management. If you're constantly inducting new people, if actually you're going to be in a period with much less recruitment, you really can. And that will be a thing that's opaque to people, and it takes quite a lot to make it transparent that there's an opportunity there. But the other thing that I found, and it's also true at Motorway, it's like just the plethora of tools. Like if you do the Excel list of what are all of the tools that we're using everywhere, it is insanely long. And lots of them are very fairly priced. So in a normal time, like, it's, not that it, but actually you can really cut into that hard and, force consolidation. You often find, well, we've got one tool here for this, we've got another tool here for that. But that could be done by this other tool, maybe not as brilliantly, but we could save all of that cost for just a small increase in the license fee here, and really pushing through. And actually, more and more there are companies, and they ping me through LinkedIn all the time, offering services to help with that. And those definitely have been helpful.
Do you ever
If
find
I
that
can add, Kai, I agree. I mean, usually people jump on cost, and it is a good thing to do, and it's a hard thing to do as well as a CFO, because we're not announcing good news. On our side, we are fortunate that we have a negative working capital requirement, meaning that we're getting paid by the consumers before we have to pay the transport service providers. And so we can keep that cash on our balance sheet. We use that to manage our runway. It is something that you need to be extremely careful with, because as I explained, if there is a reversal of situation in the market, it becomes also a huge liability. But there are ways to think of that. And I think at a smaller level, or more kind of normal level for a company, because I probably were a bit of an outlier on working capital, but looking at that as well, like per payment terms and these kind of things can also help tremendously, especially when you look at marketing spend. That usually is a huge cost for companies. They having 45 days payment terms is not uncommon, and there's a lot of people that still pay like 15 days their supply. So get information, look at peers, talk to other people, how they do on payment terms, and there's money to be had there as well.
Yeah, makes sense. Where do you find these peers? Like, how can CFOs speak to each other? Sarah, are there networks that you're in contact with?
Yes, I have some good networks in Stockholm, but I think maybe it's more important to have the conversation going with your CEO and the management team. So I don't see the CFO as like an isolated role in the management team. It's a super important key role that should work so closely with the management team. So yes, CFO networking is great, like attending things like this, getting great tips from colleagues. But still, when it comes to those changes, you just need to be so aligned in the management team, because this is not something that is easy to do. And just adding one thing, I think in a lot of startups and scale-ups, we have a fairly young employee base. So a lot of the colleagues at Epidemic, they have never experienced a world where money wasn't free, everything wasn't just going up to the right. I'm revealing my age now, but I was working in the financial crisis 2008 as an example, and that makes a difference, I think. So we also need to change the mindset and the culture of these companies, and it takes time. So since I joined 2.5 years ago, I have been speaking about cost consciousness all the time. As soon as I get the opportunity, I'm on stage talking about cost consciousness. And I would say it has taken 2.5 years, but now finally everyone understands why it's so important. And also we are a profitable company now, which is great, and it's pride for the whole company to be that. And that's the only way to run a sustainable company long term. But now I have hammered this message for so long, so hard. So now people come up to me like, yes, Sarah, I negotiated this cost reduction with this vendor. Like, yay, well done. But it just makes me so glad, because now it's becoming at least a part of the DNA of the company. But this shift in culture takes time. So don't expect that you say it in like one all hands and then tomorrow it will happen. You just need to repeat that message. But I think it's important.
Yeah, it's such an interesting line in this discussion, how CFOs communicate with the wider team and with senior management, because it's crucial. Is there, Liz, do you communicate a lot about financial thinking with the wider team, or like how do you work out what to tell everyone at the company?
I mean, it's a good question, because I think we all want to be as transparent and authentic as possible, but the reality is there are some things that we know as CFOs that is not appropriate for us to be sharing with the organization. And we have to be thoughtful about that. But I think to the extent that you can talk about it, you should talk about it, because there is, if you do get to a stage where you have to do a restructure, if that comes out of the blue, it is so much harder to do that restructure, because you have immediately, you've just broken the trust between the whole of the organization and you, and so you have to continue to be transparent with them, but find a way that is still motivating, because if I think about when you're heading into downturns, and it's not always cliff edge. Sometimes it just trading starts to soften and then it drops a bit, and you feel like this sort of slow frog boiling. Like, when is the moment when you say, actually, no, we are going to need to take action? But you have to stay as transparent as possible. But I'm also, again, with Sarah, it's not just the CFO's problem, and you can't let it be just the CFO problem. It is everybody's problem. And and with the management team positioning, you need to cut costs in your department, because that is going to stop you getting the headcount that you need to do the things that you want to do. And I'm here to help you to get to where you want to be. I'm not here as a blocker. It's a collective responsibility. And I think if you can get into that collective mindset and continue maintaining that through good transparency of information, then whatever you're facing, it will be much smoother and much quicker and better process.
How did you manage that communication piece, Jean-Bernard, when you were going through a number of cycles of hungry during COVID?
No, and for me it's a learning over the last few years that I come to realize that my team and I we never speak often enough with the organization, and if I may say, kind of teach them the ropes of finance. And every time we do that, there's loads of interests, and a bit like what Sarah was explaining, there's even demand for more. For us, for instance, we had last year a full 12-month campaign on we need to get our unit economics right. So it's about reducing cost, obviously, but variable cost, but also increasing the top line and the revenue that we can, or monetization we can have, etc. And had underestimated how it wasn't very easy for the organization. I'm thinking like product managers to kind of understand these economics, which for us seems like very obvious, but it's a completely different domain for them. And so we spend, and I spend also a lot of time actually sitting down with teams and going through business cases and explaining the dynamic and how to improve, and even kind of like very simple theoretical explanation of how a P&L works. Because I find that at the end of the day, the more you give them the tools to understand what to do, and they can think through the mechanics of the finance as well, the easier it is, because these are intelligent people, they design amazing products, they can do the simple math, and if they can combine the whole thing, it's great. So empowering the organization to think from a financial point of view is, for me, a key role of the CFO organization. And the CFO is part of that. So yeah, spending time with the teams on the ground is important. Yeah.
Sarah, how does this communication trickle down from the CFO or trickle through? Does the CFO initially talk to HR and the CEO about these things, and then bring senior leadership in, and then bring the wider team in?
I usually bring my assistant, and she types a letter and we send a memo around. No, I'm joking. It's very much I mean, we are a relatively small organization, and sitting down with people and explaining them, almost like on one-on-one, for me has a much deeper impact, because there's loads of things that pass beyond that. It's not just explaining finance or reviewing numbers, but it's also building the relationship with the business. And you can then ask questions about, hey, by the way, what happened in Italy last week, and you create those links with the whole organization that allows you after that to better understand and do a better job as a CFO. So it's certainly not one way, and it's very much person to person in my view.
Do you agree with that, Sarah?
Yeah, I agree with that. So I would say communication is such a vital part of being a good CFO where you can really make a difference, I would say. So, and also to your point that it's so time well spent, I think, when you meet with different departments and make it fun, interesting, and easy to understand, like the financial language. And when you put the time on educating employees, they get more involved. They think they want more, and I think that's the way to do it. But at the same time, you should communicate in all the forums that exist in the company. So it's the management team, it's the all hands meeting. If you have maybe a meeting or a session with all the managers, then you should communicate to all managers. You should visit the department all hands. So communication as part of the CFO role, I think it's, to me at least, it's just becoming more and more obvious how important that is for you to be an impactful CFO.
Yeah, makes sense. Just a reminder to the audience, we've got a chat box. Do fire your questions into our panelists. But first, I want to move the conversation along slightly. I want to focus on fundraising in the current environment, and like where these events now come from for scale ups. Because I think this is one of the biggest challenges for startups right now, is to figure out, like, do we fundraise in the current climate when we're likely to get far worse terms than they would have done a couple of years ago, or do we streamline the business? And kind of right now, neither of those options seem particularly like attractive. But like what are the key things that CFOs need to think about when kind of weighing those two options up, Liz?
I think there's a couple of things to think about. I mean, the first thing is, like, there is capital to be deployed to good businesses, and good companies will still get funded. And so the question is, are you a good company? Because if you're not a good company, then you will struggle to get but if you are, then you should have confidence, and you should go out and make those relationships. And then secondly, like what's the purpose of the fundraise? Is it really going to get you to where you need to be be better. And then maybe the terms will be a bit worse than other raises that you've done. But if it still makes business sense, then it will still make business sense, and you should do it. But I think really focusing on the substance and not just the narrative, I think is highly critical. I think thinking about the scenarios, and yes, we have a very enthusiastic and motivating, pitch out to investors, but we, need to think about, well, what happens, if it doesn't take off and you have taken this funding in. And then the last thing is, if you're a good company and you've got a good idea, there will be people who, will want to deploy money, and you should be in the position where you can think really carefully about who do you want to take money from. I think that's the thing that lots of companies learned in the downturn, is who your investors are and who is supporting you, who is able to support you through those downturns into the long term is really important. Do they have aligned objectives with what you want to do, and are they going to support and help you to deliver your goal, not just by giving you capital and cash, but really lifting you on as a company, I think is really critical.
Do you agree with that, Jean-Bernard?
Yes. I think for me it's important to do the hard bit first, right? Which is probably to get the company into a trajectory where it becomes financially independent and self-sustained. And we alluded to that earlier. That might lead you to impose very hard choices on the company. And then if you've been for 5 years where in an environment where money was easy and you could launch as many ideas as you wanted, etc., it's a dire shift. It's not easy at all, but that is very, very important, because I don't go into the route of, okay, we can take money and buy ourselves another runway for 2 years and the situation will be better by then. I don't know, and I wouldn't bet on that. And if you don't fix the basics, it's gonna be for sure even stronger. The other thing that I would add is also watch for terms. There are people out there, wanting to deploy money, but at terms that may seem attractive. I'm thinking about structures, for instance, may seem attractive, but be careful, because that can come back and bite you really, really hard. And so do, again, scenario planning, long term. Think about where your valuation is going to be, a low, high level, etc., and see what the actual dilution is on those terms, because you might be surprised that this is not as good a deal as they pretend.
We've just had a great question come in from the audience, and it relates to your point, Liz. What are the red flags of a not good company? What companies aren't going to get investment anymore from investors? Sarah, why don't you jump in on this one?
Wow, that's an easy one. I think I think this was really great answers on the last question from both of you. So essentially, it's back to basics. If you're not a profitable company, you're not a sustainable company. You need to have the product market fit. You need to have a company with a strong culture. So it's really back to basics. It's not that hard. So that would be my answer to what is a good company. If you have all of those things in place, then it's a good company. Then if you, for a period of time, had too high cost base, but everything else is sound, then it's easy to fix. But if you don't have a product market fit, if you don't have all of those things, then it's super hard. Yeah. So that would be a red flag for me.
Sure. Gonna go to one more audience question from Dan, who asks, if you're a one-person finance department of an early stage startup, what are the first hires you need? Like where should you put limited resources, Liz?
Well, you put limited resources where they're going to give you the best return, and it depends exactly how limited you are. I think you have to have something that is going to sort of change your equation over time, and so that might be something that is less certain in its returns, but it would but you can't do that everywhere. So you have to be extremely thoughtful about, these are the bets that we're going to make. Minimize the number of bets that you have because you've got limited resources, but you have to have at least something that will change the dynamic in the long term. Otherwise, you're just in that phase of, I hope we don't run out of runway before something magical happens in the market. And then you're not in control of your destiny. And it's very hard to do any kind of strategic planning in that instance.
Yeah. And we've seen it happen with loads of major, really well-funded startups over the past year or so, where they've had to restructure their business and like hunker down. At what point should a CFO begin to consider that as an option? Is that a last resort, Jean-Bernard, or should it not be a last resort?
No, I hope it doesn't come as a last resort, because then it means you haven't taken that decision soon enough. It's you, for me, if and back at what Sarah and Liz said, if you are not on a clear path to very quickly become a profitable and sustainable company, then you probably don't have the right plan. There might be exceptions. Maybe you just founded a new AI company and it's all great, etc. You have maybe 2 years in front of you before you do that. But most 90% of the companies need to be in that range. And if for that you need to let go of people and reduce costs by all means possible, it's time to make that decision. But don't leave it as a last resort, because then it's really, really awful. And then you need to start cutting really into the bone and to the long-term future of that company. So yeah, I would do it to make sure you are on that path. And then when I say short-term, it's like 12, 18 months maximum. It's not like 2 years or 3 years, in my view. I mean,
what about alternative financing options then? We've seen things like debt financing begin to pick up real traction in the past couple of years, and debt financing used to be a really dirty word in the tech world. But it seems, more startups just are turning to it. Sarah, are there good reasons to turn to debt financing? Is that the right option sometimes?
For me, that's super hard to comment on, because we are not considering that option, and we have, as I said earlier, infinite runway. So what we are focusing on instead is maturing the company. So going from a startup to a scale up, and just general readiness, you could say, as a company. So maybe you should direct that question to someone else.
Well, and we talk about readiness then, and this is this readiness for when the public markets open up again?
Could be. We don't know if we would ever be a public company, but I think general readiness is good regardless, because it's part of maturing as a company. And when you grow the company, both in terms of number of employees, revenue, then you should also increase the maturity of processes and internal control, etc. So I'm super glad that we have spent a lot of time doing that, because I also see a lot of benefits coming from that. Just back to basics, get your house in order. These are just like the fundamental and basic things you need to do. And if you would like me to talk about where you should start, I can do that.
Yeah. Give us a little bit of
Yes.
detail.
Yes, general readiness. This is great. Well, first of all, it takes time. So my recommendation would be to start early, and this can't just be a priority for the CFO office, because it's both a cultural shift within the company, but it also spans across the company. So in terms of, for instance, internal controls, you have the commercial controls. At the same time as you have the business controls, you have the IT controls, and you have the financial controls. So it includes a big part of the organization, and that takes time. And I would also say, from a culture perspective, so when we started this work, reviewing policies as an example. So the only policy that existed at Epidemic Sound was a policy that we don't have any policies. So, I mean, and that was right at the time. I mean, for a startup, that's great. But as a mature company, that's not the way you operate. You shouldn't. So going from a mindset and a culture that was the only policy to a mature world where we have implemented an enterprise risk management framework, we have the risk appetite discussed with the board, and I think that is actually really a helpful tool for me as a CFO when it comes to risk appetite for different, like it could be commercial questions, legal questions. So yeah. I would say like start early. You need to get people within the whole organization with you to understand the value. And also just one general tip would be, if you work together with an external counsel, they will just give you this very general help or policies or whatever they help you with. I would say lean in, put in the hours to take that general advice and make it useful for your company. And I think we spent a lot of time on that in the beginning, which now means that we have, for instance, a risk management framework that clearly adds value. And I can sit in a meeting where we're discussing a commercial question, and they're like, yeah, is this rhyming with the risk appetite? And you're like, yay, yes. Then you know it adds value on the total.
Is readiness a word that that you use in Motorway, Liz? Is that like a state of being that you're going towards?
So it's definitely a thing that I think about, and I think about a lot. And we are working on it. And mostly for the things that Sarah said, because it's just good practice. It's good governance to have all of these things in place. When you understand and have clearly articulated what the risk appetite is, it shortens many other conversations that would have just gone round and round in circles. I think we should, I think we shouldn't. It all feels a bit grey area. So it brings structure and clarity to some of those more woolly conversations that risk can turn into. I think, in an earlier stage organization, there's you have to balance how soon sort of the rest of the organization gets distracted. Like, you still got to build the core business first. There's no point being ready if you haven't got anything to be ready with. So everybody else has to be focusing on that. But the earlier we start embedding these practices, the better we will be. So we are starting to just sort of drip feed those things in and build towards it slowly, so that we definitely don't want to be in a position when suddenly there's a market opportunity that opens up and the founders and the leadership like, yeah, we should do this. I'm like, well, hang on a minute. We've got 12 months worth of control frameworks, etc., to set up before we can do that, and then we miss the window.
Yeah. I just want to turn to the Q&A chat box quickly. We've got a question that asks, when, in terms of months and weeks of runway, would you consider starting to cut staff to increase runway? When would that be, Jean-Bernard?
It depends on the type of company you have, the volatility that you have, and your risk. Your appetite, for risk. First of all, there are legal obligations. So depending on the country you're in, sometimes this can be up to 18 months in advance. If you feel that there is a risk to your company of going bankrupt, you need and you are required to take actions, and you need to demonstrate that you have done that. So that is for sure the kind of last resort. I find that at least 2.5 years of runway is needed in the environment in which we operate, because, as I mentioned before, there's so many fluctuations that can affect your runway very, very, very quickly. That's all my views, but it really depends very much on company to company.
Yeah, makes sense. And let's look to the future, as we got about 6 minutes left. What are the priorities going forward into 2024, Liz? Like, Have you got some metrics in your mind that you'll be focusing on in the coming year?
I'm really thinking about like productivity of the organization. So revenue per employee, and making sure that's moving up. Also looking at because that's a significant contributor to our unit economics. So as we try to get through to profitable quite soon, looking at those unit economics, understanding how they have evolved and how they are going to evolve over the next 12 months, I think is the most critical thing for us at Motorway. And then continuing to build out better understanding of our markets and how we start to be more predictive and prepared for what are the dynamics, what are the leading indicators of how our market moves. And that's difficult for us because we're slightly changing how the market works, but that's sort of all the more reason for us to be over the top of that, so that we can also then start to educate partners that, look, see how behaviors and patterns are changing because the market is shifting, and therefore this is how and why you should partner with us.
So what are your priorities?
Pretty much the same. So profitable growth is super important, balancing growth and profitability at the same time. And I think that is also back to the discussion in the management team. You need to have two thoughts in your head at the same time, because when you're a company, you have product market fit, you know that it works. So you still want to grow. At the same time, you want to do it in a mindful and thoughtful way. So that will just continue into next year. Continue to double down on cost consciousness and prioritize the projects that are bringing the most value for the company. Securing cash, strong balance sheet. And I would also say having a clear strategy for AI, both in terms of how it will affect your product, but also internal efficiency. Because yes, it is a tech revolution, but it's also a productivity transformation. And we have already today implemented an AI featured tool within the legal department that significantly has increased efficiency in terms of how quickly we can turn around agreements, as an example. So also,
what is that tool? Is that like an outsourced tool? Is that something you built in-house?
Yeah, so it's an external software, but we can see some real efficiency benefits, and it also gives us much more data. So It's great. So I just foresee that will happen within all support functions. So I'm pushing my teams hard to be out there, attend demos, like go to webinars, because we want to be leaning in. But at the same time, you don't want to implement things too early before it works well.
Jean Bernard.
Yeah, very much the same thing. Path to profitability, making sure that we cross that bar, and that's going to be so awesome next year. I would say, just not to repeat, but for us, what will be important going forward is capital allocation. So really getting all the management team to see the company in the same way and agree that, first of all, we cannot do all the ideas that we have, so we need to choose. And what is the framework for choosing that? And what are we going to prioritize? Because now we have different business units within the company, and so we can start to see a little bit of competition, internal competition for resources. And so it's going to be important to agree what is the metric and what level of return on investments, for instance, we want to have, and what's the risk leading to that. So that's a big priority for me to bring into the company.
Makes sense. Well, look, we've got about 90 seconds left, I reckon. So I want to go around quickly and just ask you all whether or not you're particularly optimistic about things becoming more positive in 2024, or if you think it's going to take a little bit longer for things to kind of level out. Liz, let's start with you.
Well, I am an eternal optimist, which is a problem when it comes to forecasting, by the way. But yeah, I feel like we're through the worst. I don't know when things are going to get better, but I feel, and certainly in our business, starting to see some indications of stability, that at least allows us to build confidently, from that, and then be ready for when the upturn comes.
Sarah.
Well, back to the scenario planning. So I would say plan for the worst, hope for the best. Let's see.
Which one do you expect?
I'm slightly optimistic. So I would say 40% worst scenario, 60% good scenario. But yeah, I'm kind of like Sarah. Just make sure you know what to do in case things go south. Yeah,
that's exactly the sort of clear data we want. There's a slightly better chance of things going better than they will get worse in the next. Perfect. What a note to end on. Well, look, that's about all we've got time for. So thanks so much for coming along and getting involved in the discussion. Thanks so much to our panelists for sharing everything so candidly.